what we're going to be going over here is what they refer to is the contribution margin here when we're talking about cost volume profit analysis in cost accounting here. So this is a concept that we have to understand here. The underlying concept here when we're looking at profits here between our costs and our revenues. Okay, so what we're going to start out with here is we're going to be looking at this contribution margin in terms of some numbers here that I've laid out here on a graph here, the cost volume profit graph here, and then we're going to go back and we're going to be looking at how we'd apply that contribution margin method here to equations that we use here for cost volume profit analysis. Okay, so let's go look at what we have here. When we're talking about this cost volume profit analysis, really what you have is you're going to have your total revenues here versus your total costs. And you're going to be looking at the case here where you're going to be attempting to earn a profit here on your product. Okay, so let's go look at what we have shown here. So for our cost volume profit analysis graph here, we're going to be showing the units sold here across the bottom here on our x-axis. We start out at 0. We're going to go up to 200 here. And then on our y-axis, those are our dollar amounts here. And those are for our costing dollars and our revenue dollars. Okay, so for our example here, we're going to have our total revenues line here. I'm showing that in blue. That's going to start out at 0 here for units sold. You're going to have 0 revenues because you've sold 0 units. But it's going to increase here at the rate here of $50 per unit. That is the selling price here, $50 per unit. So every unit sold, your total revenues line here goes up by $50. Then you have your total costing line here. Well, your total costing line here is really your, in this case, we're going to have a fixed cost here of $2,000 here. So we're going to start out here at 0 units sold. We're still going to have this fixed cost here at $2,000. So however many units you sell, you're still going to have the constant fixed cost. It doesn't change here. So if you sell 0 units, you still have the $2,000 fixed cost, or if you sell 200 or more, you still have the $2,000 fixed cost. But now when we come into our contribution margin that we're going to be looking at here, the difference between our revenues here and our cost, we have to work with this variable cost here. In addition to the fixed cost, we're going to have a variable cost here per unit here of $30. So for every unit we sell, we're going to have a variable cost here of $30 that is above our fixed cost. So what you're doing here in your cost volume analysis here, you're going to be looking at some intersecting point here between your total costing line and your total revenues line. And this would be what they refer to as the break-even line here. So at some point, your total costs equal your total revenues, and those would be based on some units sold here. So anything below those number of units, anything less than that break-even point number of units sold, you're going to be operating at some loss here. And anything greater than that break-even point here for the number of units sold, you're going to be looking at some profit. So back to our problem here that we're going to look at for this contribution margin method here. Now, okay, we've had our, let's just go up and look at our revenues and our total costs here. So we were talking about that 170 units that are sold. That's what we're going to be using for our example here. So back to let's look at here our total revenues here. That at this 170 units sold here, that would be those $50 here per unit here that we receive the selling price at $50 per unit times the 170 units here, and that's going to be equal to $8,500 here. That's on our total revenues line here. Now for our total costing line here, of course, what do we have? We have got the fixed cost here at $2,000, plus we have the $30 per unit here of variable cost. So what would be our total cost here at that 170 units sold? So that would be our fixed cost of $2,000 plus the variable cost. And let's look at what that variable cost is here. This is really the key here when we're talking about this contribution margin here. So the variable cost, we're looking at, in this case, the total variable cost. That would be the variable cost per unit here of $30 times the number of units sold here, 170 units here. So that total variable cost here is $5,100. So this is what we're going to be looking at here for this contribution margin here. We're going to be really concentrating on our total variable cost here and our total revenues. So going back to our total cost here, again, that fixed cost of $2,000 here plus variable cost, a total variable cost here of $5,100. So our total cost here is $7,100 here for those 170 units sold. Okay, so now we've determined our variable cost here, total number of a total variable cost here for those 170 units sold. We've got our total revenues here that we determined again for the number of units sold, 8,500. Variable cost was 5,100. Our total cost here is $7,100. So now we'll look at it in the profit here. That would be the total revenues here at that point here, $8,500 minus our total cost here of $7,100. So we're going to have a profit here of $1,400. I went through these numbers here because we're going to look at how we prove them out here when we use this, how we use these different costs and variable costs, fixed costs, and profits and total revenues here in dealing with this contribution margin. So now we're going to get into the contribution margin here. And by definition it is that total revenues here, I'm showing in blue here, that A amount here, minus your total variable cost. So our total revenues here was $8,500. Our total variable cost here is $5,100. So the difference between the $8,500 here in total revenues and $5,100 here in total variable cost is the contribution margin that we're going to be looking at. And in terms of the number of contribution margin per units here, that would be, in this case, the difference here, that contribution margin, let's look at it, was the 8,500 total revenues minus total variable cost here, 5,100. That gives us a contribution margin here of $3,400 based on those 170 units that are sold, based on, again, our selling price here of $50 and our variable cost here of $30 plus the fixed cost here of $2,000. So now on a unit basis here, the contribution margin would be simply the total $3,400 here divided by the 170 units that are sold. So on a unit basis here, you get $20 per unit here. So for each unit you sell, you're going to have $20 here as a contribution towards your profits and your fixed costs here, and your variable cost that you're looking at here. So you're going to, based on our definition here, total revenues minus total variable cost, that is the contribution margin. And we looked at it in terms of the gross amount here, total gross amount, and then we looked at it in terms of the number contribution margin per unit. So this is the key here. You're looking at really the change in slope between your selling price and your variable costs. So if the case, and this is what we're looking at in terms of a profit here, difference between our total revenues and our total cost. So the idea here is if you get a change in the slope between your total revenues and your total cost line. So obviously, if your variable cost per unit would go down here, you'd have a lesser slope here based on, and then comparing it to your total revenues line here, say it stayed the same, so you'd be earning a greater profit here. So you're really looking at the change in slope here between the selling price here and your variable cost, assuming your fixed cost stays the same here. So if you can reduce your total cost by having a lower variable cost here, then your total cost line is going to go down in comparison to your total revenues line here, then you're going to have a greater profit here. So that's really what we're talking about when we have this contribution margin. You're looking at it on a per unit basis here, and then you're also looking at it on a total amount, a gross amount basis here. So if you can get that contribution margin in your total variable cost or your total cost line here, and your variable cost down, then you can have a greater contribution, assuming your total revenue stays the same. You could also look at it increasing your total revenues here, get a greater spread between your total cost, then you're going to have a greater profit here and a greater contribution margin. Okay, so that's basically how it works. Now just looking at our basic equations here before we go on. Again, contribution margin per unit as we looked at it, that was the selling price here minus the variable cost. So our selling price, for example, here was $50 per unit, variable cost $30 per unit. So the difference here is going to give us that $20 here per unit. So if for each unit we sell here, we're going to have $20 contribution margin per unit here. But the $20 isn't all profit. We have to take care of our variable costs here and our fixed costs. But this is just the rate here really of change between our selling price and our variable cost. And then we're going to also be looking at the case here with the contribution margin as a percentage or ratio. That's an important item that we have to look at. That's really the selling price minus your variable cost divided by your selling price here. So in terms of our contribution as a percentage here, it's just the $50 selling price, variable cost here $30 divided by $50. And for our example here, it's 40%. So what we're looking at here in this contribution margin, really what we're looking at here, the contribution margin indicates why our operating income, I use it as a profit here, but this would be our operating income, how it changes here based on the number of units sold. So if we can get our total cost line down here, or our total revenues line up, we get a greater spread between the two here, then we're going to have a greater contribution margin, both in the gross amount here, based on the number of units sold, or on a per unit basis itself. So that's why we're looking at this contribution margin, and that's why it's important. Okay, so now let's go up here and let's start out with some of our equations and get an understanding. So again, our contribution margin, and everything really starts off this operating income equation. So what you have for the operating income equation here, you're going to have your selling price minus your variable cost that we looked at. Whatever that difference is, you take it times the quantity sold here. But that amount here, you have to subtract out your fixed cost here. And the difference gives you your operating income. So the key here, when we're talking about that contribution margin here, is our change in quantity sold is going to affect our operating income. So contribution margin, again, indicates why our operating income here changes with the number of units sold. Okay, so for the contribution margin itself here, on a per unit basis, it's the selling price minus the variable cost on a per unit basis here in dollars. So for our example here, just using our operating equation here, we're going to be able to determining our operating income here. And remember, on our graph, we looked at our operating income here of $1,400. So I'm just going to go through equations here to determine how you use that contribution margin to determine your different quantities, your units sold and so forth, and operating income. So for our example here, we had that $1,400 in operating income. So that is really the difference here between we calculate that by taking our selling price here minus our variable cost here, $30. That we would take times the quantity units sold here, $70. But we have to subtract out that fixed cost. We had that fixed cost at $2,000, and that's going to equal our $1,400 operating income. Okay, so contribution margin, simply the difference here between selling price and variable cost. That's $20 times our quantity sold, 170 units here, minus the $2,000 fixed cost. Again, that equals our $1,400. Just to point out here that contribution margin is the selling price minus the variable cost here that we want to put out. So now we can look at it in terms of just the percentage here, contribution margin percentage. Again, our selling price minus our variable cost here divided by our selling price. That is going to be the contribution margin percentage. And that's a key item here when we have to go on and do some analysis here. So again, that was the selling price, $50, variable cost here, $30. That's the contribution margin divided by a selling price of $50 here. So we're going to get that 40% here, or 0.40 ratio here. So what that's really telling us here is for every dollar of revenue that we take in, 40 cents of that dollar is the contribution margin. It goes to the contribution margin. Okay, so that's the 40%. So in this case, we would have earned $20 here per unit based on that contribution margin, or it would be $20 here divided by the selling price here of $50. $20 contribution margin. Again, that equals the 40% here per unit. Now, when I say earn $20 here, that isn't all profit here. You've got to cover your fixed costs here and also your variable costs until you come up to you're looking at the point here where you're looking at making some profit. Okay, so now let's go and let's apply our using this contribution margin method here and applying it. So first off, let's look at the case here. How many units must be sold to earn an operating income of $1,400? So we're working with that $1,400 that we originally started with here. So this is the equation that you use here for the contribution margin. The quantity sold equals, we got to cover our fixed cost plus our operating income divided by that amount divided by the contribution margin per unit. So quantity required to sell to earn the $1,400 in operating income is this fixed cost here, $2,000, plus our operating income here of $1,400 divided by the contribution margin per unit here. Remember, we determined that to be $20 per unit. The $50 selling price minus the $30 variable cost contribution margin per unit. So you just divide everything out here, and there you come up with the 170 units that we had to sell, and that's what we've been working with. That was the number of units that we're following through in this problem. So just remember that here. Fixed cost plus operating income divided by the contribution margin on a per unit basis here equals the quantity. So a quantity you have to sell to earn a certain operating income. Okay, so let's go down here and let's look at the second case. So what revenues are required to earn an operating income of $1,400? Up above here, we had to determine the quantity that we had to sell here to earn the $1,400 here in operating income. Now we're going to have to determine the total revenues here required to earn this $1,400. So again, this contribution margin method here, it comes in handy. So this is the revenue required to earn $1,400. Again, is the fixed cost here of $2,000 for our example here, plus the $1,400 of operating income. So that amount, this is the case where we divide it by the contribution margin percentage here, or ratio of 40% that we calculated. So dividing out your total amount here, what is that, $3,400 divided by the 40% contribution margin percentage, you're going to come up with $8,500. And that's what we were using on our graph when we looked at our graph originally here. We had that $8,500. That was our total revenues. That was at $50 per unit times the 170 units that we sold. So that's just how you go about calculating here what revenues, total revenues that you have to sell here in order to have your operating income. So in this case, remember, we have to cover our fixed cost here plus our income itself here, $1,400, divided by the percentage of contribution margin here. Okay, and then you can also look at it here in total, in just some rationale here for our equation up above. Just take our contribution margin here of 40% times the revenue dollars that total revenue dollars that we need here. That would equal the $2,000 fixed cost plus the $1,400 here in operating income. Just move your 40% over here, divide each side by 40%. That's going to give you revenue dollars here, total operating fixed cost and operating costs here, $3,400 divided by the 40% here, contribution margin percentage. That again gives you the $8,500. So those are compatible here, these things. But this here is just going through the rationale of our equation that we need here, and everything is built off that original amount that we looked up here. Let's look at it. Those were the quantity sold equals our fixed cost plus our operating income, and we looked at the contribution margin on a per unit basis here to determine the quantity of units that we had to sell here, and we looked at it in terms of the contribution margin here on a percentage basis to determine our dollars or revenues that we needed to earn a certain operating income. Okay, so we've gone through that. Now let's go down and just look at one other point here. Let's look at the case here where we're going to have a break-even point here. Remember, that's where, so really what you're asking is what quantity of output sold at which your total revenues are going to eat your total costs. So remember, we looked at it on the graph here where, again, where that was the line intersection here between our total costs and our total revenue. So again, all you goes to your equation here. Now, this is the case here. We're only going to have, since we only have to cover our fixed cost, we only include that here in our numerator when we look at this equation. So the break-even quantity here equals the fixed cost, and that was divided by the contribution margin on a per unit basis. So we can look at it here. Quantity required to sell for that break-even point where total revenues equals total cost. Our fixed cost here, remember, for example, is $2,000 divided by the contribution margin per unit of $20. That was that $50 selling price and $30 variable cost. Give us the $20. Dividing it out, you're going to come up with a break-even quantity here of 100 units. So if you sell anything less than 100 units here, you're going to be operating at a loss. Anything more than 100 units, you're going to be operating at a profit. But the key is here, you want to sell as many as you can. The more units you sell, the greater operating profit you have. The less units you sell below your break-even point, the greater loss you're going to have. And then looking at it in terms of revenue required to break even, again, just use your fixed cost here divided by the contribution margin as a percentage here. So that 2,000 divided by 40% is going to give you, you're going to need total revenues here of $5,000, which is going to equal your total cost. So the key is here when you're dealing with these contribution margins here, margin method here, just remember when you're looking at, it depends whether or not you're looking at total operating income or just covering your costs. Whatever you have here in your numerator up on top, dividing it by the contribution margin on a dollar basis here, when you're per unit dollar basis, that's going to give you quantities here. But if you look at it in terms of dividing it by the contribution margin here as a percentage here, then that's going to give you revenues that you have here. So just remember that per unit basis here, or per unit basis here in dollars is going to equate to quantities that you'll be selling, units sold here, and a contribution, and looking at the percentage or the ratio here divided into whatever your costs or operating income is here, that's going to give you a dollar amount. Just remember those key points here. Okay, so that'll summarize what we're talking here about, was this cost volume profit analysis with the contribution margin method here. So contribution margin, key concept here in cost accounting when you're looking at cost volume profit analysis.